Imagine standing at the edge of a quiet prehistoric settlement. The sun is just rising, painting the sky with soft gold. Two humans meet on a path. One carries a woven basket filled with dried fish. The other grips a smooth white stone that people in their community value. Neither person speaks much, but both know what this moment means. An exchange, a chance to survive another day. Long before charts, order books, or digital markets, trade was the heart of human life. Back then, people traded because they needed to. Food, tools, shelter, anything that kept the tribe alive. But trading wasn't always simple. For a successful barter, both sides had to want exactly what the other offered at the same time. If I needed grain, but you only wanted animal skins, we had a problem. This friction pushed human beings to search for something better, something that could simplify exchange, reduce uncertainty, and make life easier. Slowly, certain objects became trusted as mediums of value, things that were durable, portable, and widely accepted. Salt, beads, shaped stones, later, metals. These items weren't valuable because everyone needed them every day. They were valuable because people believed others would accept them. That belief, trust, became the foundation of early economies. Every exchange required confidence that someone else would honor the value of what you received. Trust became more important than the items themselves. And where trust existed, fear was pushed back. People traded more easily, traveled farther to exchange goods, and relied less on chance. But whenever doubt appeared, fear returned. Rumors, uncertainty, scarcity, these could collapse a trading system faster than physical danger. Fear has always lived beside value. It was true thousands of years ago, and it is still true now. This shift from trade by need to trade by value was not just an economic innovation, it was an emotional transformation. Humans discovered that reducing fear made trade more productive. They learned that certainty expands opportunity. As communities grew, they began creating simple standards, measured weights, carved marks, consistent practices. These early forms of financial systems existed not because the world became smarter, but because people needed a way to control their emotions, especially fear. The lesson is clear. The creation of value, currency, and exchange has always been an emotional journey. We didn't just invent money to solve practical problems. We invented it to manage human feelings, to make decisions less vulnerable to panic, doubt, or impulsive reactions. Even today, in a world of crypto markets and high-speed trades, we're still living out those same dynamics. Markets move on value, yes, but they also move on trust. They rise and fall based on confidence. And beneath every decision, then and now, is the trader's greatest challenge: mastering emotion. As we continue this story, a quick note naturally woven into the narrative: everything shared here is educational, not financial advice. Use it to inform your discipline, but always make decisions based on your personal circumstances. Now, with that in mind, let's move forward from ancient pathways to modern markets and uncover how the emotional foundations of early trade still shape the way traders behave today. Money is not just a tool, it is emotional. Behind every transaction, behind every asset, behind every sudden price movement, there is a heartbeat. Someone feeling fear, hope, greed, hesitation, or excitement. These emotional forces have influenced trade since the beginning of human exchange. Fear is one of the earliest emotional signals humans developed. It kept our ancestors alive by warning them of danger. But that same fear now appears when markets dip, when news spreads uncertainty, or when a trader sees their position move against them. Fear can protect us from reckless decisions, but it can also push us to act without thinking. It is powerful, immediate, and deeply human. Consider the first time someone accepted a new form of early money: a bead, a token, a shaped piece of metal. They had to trust that others in the community would also accept it. If confidence was high, trade expanded. If doubt spread, acceptance collapsed. Even without charts or indicators, these traders felt the emotional pressure of value fluctuating. Their internal responses shaped the success or failure of entire systems. Trust, the counterbalance to fear, grows slowly but can disappear in a moment. It is built through consistency, fairness, and predictable rules. In early communities, reputation created trust. People traded more easily with those who kept their word. Later, systems and standards created broader stability. Modern markets still run on the same formula. Value plus trust minus fear equals stable exchange. But the speed of information today has amplified emotional reactions. What once took days to travel across villages now spreads instantly across the world. A rumor can trigger panic. A headline can spark euphoria. A single unexpected move can shift market behavior dramatically. Greed plays its role. Where fear tells us to avoid loss, greed whispers that we could gain more. In ancient marketplaces, greed may have encouraged someone to demand a higher price. In crypto trading, greed may push someone to chase a candle or hold a winning position far past their plan. Both emotions can distort logic. Despite the technology surrounding today's financial systems, traders still face ancient psychological challenges. Your mind processes danger the same way it did thousands of years ago. A sudden drop in price can trigger the same stress response your ancestors felt when encountering a predator. The body reacts first. The mind rationalizes later. This is why emotional mastery matters. Your ability to recognize and manage fear, not eliminate it, but understand it, determines the quality of your decisions. A trader who doesn't control fear will react instinctively instead of strategically. Markets don't punish bad luck. They punish disciplined reactions. They reward structure, planning, and emotional control. When you understand that your internal world is the real battleground, you realize why so many new traders fail. They try to fight the market instead of mastering themselves. In the next chapter, we explore how the emotional lessons of ancient trade extend directly into the world of crypto and modern finance, revealing patterns that repeat themselves across every era.
As centuries passed, trade evolved from simple bartering to organized systems of money, credit, and record-keeping. Coins, paper currency, and centralized accounting changed how people interacted with value. But in every transformation, emotion remained the anchor. And now, in the digital age, we face one of the most significant innovations: decentralized digital value. Crypto, at its core, is a modern reflection of ancient systems. It uses scarcity, community trust, and agreed-upon rules to define value. Just like shells or metal tokens, cryptocurrencies only hold meaning because people accept them as valuable. And just like early systems, the acceptance of these digital assets depends on trust. Trust in the technology, trust in the network, and trust in the collective belief of others. In this space, fear and trust move faster than ever. When a large seller appears, people panic. When optimism spreads, price surges. Traders respond emotionally long before they respond logically. This is not a flaw in crypto. It is a reflection of human nature. Digital markets can swing sharply because they remove physical limitations. There is no slow travel of information, no pause for reflection. Markets operate around the clock, and emotions adapt to that rhythm. A single tweet or rumor can change sentiment instantly. For traders, this environment magnifies every internal strength and weakness. Yet, the principles remain the same. Value comes from belief, belief comes from trust, and trust is shaped by emotional reactions. That's why fear spreads so quickly in the crypto space. It's why inexperienced traders often buy too late or sell too early. They're not responding to charts. They're responding to ancient emotional triggers that have always influenced humans. Understanding that crypto is both technological and psychological changes the way you approach it. When you see fear-driven sell-offs, you understand the emotional cycle behind them. When you see hype-driven surges, you recognize greed at work. When you feel pressure to act impulsively, you're experiencing the same sensations early traders felt thousands of years ago. This continuity offers you an advantage. If markets today are shaped by the same emotions that shaped ancient exchanges, then emotional discipline is the real edge. Technology will evolve, strategies will change, tools will get more complex, but the person who controls their emotions will always have an advantage over the person who doesn't. The final chapter will turn these ideas into practical steps, clear, actionable methods to prevent fear from sabotaging your decisions and to help you trade with structure, confidence, and clarity. Mastering emotion is not about becoming cold or detached. It is about building structures that protect your decisions from impulsive reactions. The market is not your enemy. Your undisciplined emotions are. To trade effectively, you must build habits that keep fear in its proper place. One of the strongest tools is pre-commitment. Before entering any trade, write down your plan, why you are entering, your entry and exit points, and the maximum loss you are willing to accept. When fear appears, and it will, this plan becomes your anchor. It prevents panic and returns your mind to logic. Position sizing is equally important. The larger the risk, the louder your emotions become. Reduce your position size, and you reduce emotional intensity. Many traders fail not because they are wrong, but because they risk too much too soon. Checklists also help. Under stress, memory becomes unreliable. A simple checklist keeps you aligned with your strategy. Include things like your reason for entry, trend conditions, confirmations, and invalidation points. Completing a checklist before entering a trade forces your decisions through logic instead of impulse. Another key habit is timing your attention. Markets operate constantly, but your mind cannot. Scheduled reviews help you avoid constant emotional pressure. If you only check the market at structured intervals, you give your brain room to think clearly instead of reacting to every small movement. Rehearsing loss scenarios reduces the shock of seeing red positions. When you mentally accept potential losses before entering a trade, you prevent emotional overload later. Ancient traders expected setbacks. You should too. Journaling is a powerful psychological tool. Write down not just your trades, but your emotions during each one. After weeks or months, patterns will emerge. Times of day when you are impulsive, conditions that trigger fear, moments when you abandon your plan. Once you see your emotional patterns, you can correct them. Finally, use a quick grounding ritual for moments of panic. Take 3 slow breaths. Read your pre-commitment sentence out loud. This simple pause resets your mind and gives you the clarity to move intentionally instead of reactively. Everything across history, from early bartering to digital markets, shows that fear is part of trade. But fear only wins when you allow it to make decisions for you. When you structure your approach, your emotions become signals instead of obstacles. Here are 3 key takeaways to guide your journey. First, emotion is information, not a command. Fear should make you evaluate, not panic. Second, structure protects you. Pre-commitment, position sizing, and checklists turn discipline into a habit. Third, trust and consistency build long-term success. When you control your internal world, the external market becomes far less threatening. Remember this, every trade is a story, and the storyteller is you. Master the voice inside you, build systems that strengthen discipline, and let reason, not fear, guide every decision.